Hi, good evening, everyone. Thank you for joining this evening's webinar. I can see that most of you have joined from your place in Portugal. However, I can also see there's a few people who have joined the call who are perhaps thinking of moving to Portugal. So I'll try to answer as perhaps many questions that's on your mind as possible this evening, albeit following the key subject headings for the presentation. However, if for any reason I leave more unanswered questions or I raise any more questions than answers, which someone said to me once, then not to worry. We're more than happy to take emails or perhaps even initial discovery meetings with some of you to help answer more of those questions and relate that more to your position and your situation. So we'll get started. The key topics we're going to cover is just a brief introduction as to who I am and who Skybound Wealth Management are, the company that, of course, that I work for anyone who's not aware of us on the call. And then we'll get straight into the Portugal NHR changes, which are coming in since the disbandment of the old NHR regimes, NHR 2.0, and then some financial planning to consider for anyone living in Portugal whilst they're on non-habitual residence, but more importantly, when they're going through that switch from being NHR to non-NHR and going into the normal tax regime of Portugal if you're staying here long term. I will throw in some snippets about potential countries you could move to around, because that's always the questions I get. I can't cover every country, of course, but that should give you all a nice idea on things you should be thinking about, whether it's now or over the next few years up to the end of NHR in Portugal. As an introduction, of course, my name is Ryan Edward Donaldson. For anyone that can't tell on the call, I am from Scotland. Although I've worked internationally for 10 years, I don't lose the accent. I'll try to speak slowly as I can for you, but it's in our nature to speak a little bit faster than normal. But again, if you can't understand me, you can send a question at the end. So these are all my qualifications and awards. I think it's just important you know that I am registered in multiple countries around the globe. Look, my background is in UK financial planning. I'm a chartered fellow with the Chartered Institute for Securities and Investments, which is a UK professional body. However, it's important that all of you know on the call that I would say 20% of my advice actually is constituting UK financial planning. What I mean by that is I left the UK 10 years ago. I worked in Belgium. I worked a little bit in the Middle East as well before that. But I worked in Belgium, France. I moved down to Switzerland. I was resident there for 6 years in Geneva, and I was providing advice all through Europe. My main countries of focus are France, Switzerland, Spain, Portugal, with the UK, of course, still being a big focus as well. I'm registered by the FCA, of course. I'm registered through Europe as well with MiFID II, and I'm also registered in Switzerland by FINMA and ARIF on that side. My passion lies with helping individuals cross-border planning. I don't really get the same kick out of UK planning in terms of maximising your SIP contributions, your ISA contributions, you're doing your capital gains tax rollovers and your allowances, helping people with income drawdown and inheritance tax planning. Yes, I enjoy it. I still do all of these things, but what I really like is helping people with the cross-border planning. There's probably many of you on this call who are in Portugal for a specific purpose, mainly around maybe perhaps a company you've set up or you're looking to retire there, or you've just moved for the favourable tax regime. There's no shame in saying it. Most people do. And it's a case of you've probably left assets, whether it's property, retail banks, private banks, shares in company shares and personal portfolios, life bonds, all these structures and assets that come with building your employment or your businesses over time. And you're now thinking, well, how do I structure my time here? These assets are based in multiple countries and different jurisdictions, and that's what I enjoy the most. It's helping with that cross-border planning and helping people understand how certain vehicles and certain assets are treated in different countries and how you should be changing those vehicles and assets, whether you're in Portugal or France or UK, because each country will treat the assets differently. They all have their tax intricacies and different laws within that. The company that I work for above me, I'll just move my head so you can see the Trustpilot reviews as well. On the left, on the right-hand side, is called Skybound Wealth Management. Skybound Wealth Management, I've been here for this coming up for my 11th year now. They're an international company. Skybound Wealth started in the UK 26 years ago. They've still got a very big print in the UK. We've got offices in London Mayfair, London Bridge, down in Dorset Pool, and also further up north in Sheffield for the marketing and administration roles. And we've now got offices all over the world. So we expanded to Europe and Switzerland around kind of, I think 18, 19 years ago, across in the US, South Africa, Middle East, Cyprus, and also some operations in Asia as well, which aren't on this board. The only thing I would say that matters for you all on the call to understand is that each area we operate, we are regulated locally in that jurisdiction. So, for example, if we're advising you on your UK financial planning with some of the services I spoke about on the previous slide, that would come under the Financial Conduct Authority here on the left-hand side, which governs the UK financial planning regulation. Likewise, if we're advising you on perhaps some of the Swiss assets side and Swiss investments, private banking, that would come under FINMA or ARIF, which is we're dual regulated there. Likewise, in the Middle East, it's the insurance authorities and the ESCA dual regulated. We've got the SEC in the US and MiFID II through Europe, which covers all European advice, whether we're going with Portuguese local solutions, French local solutions, Spanish local solutions, or even perhaps European pension-esque vehicles. All of that would come under MiFID II in that area. For anyone that's on the call, perhaps that has 401ks, RAs, or anyone that's worked in the US before, I am not Series 65. I'm not US qualified. However, I do know a lot about it from my time dealing with clients and case studies. However, if any of that advice with one of my colleagues would come onto the call within the Skybound umbrella, and we could help service you with that side, and myself on the European side. Look, just general advice disclaimer. Please take the information on this webinar today as information only. Don't take it as advice specifically to you. The reason I say that is because depending on where your tax residence lies, depending on where you're thinking about moving to next and be tax optimized next if it's a different country, depending on where your assets are based, will dictate the advice that we give you. So we'll give you some headline information to think about today. Take some of those parts on board, but it's really important that you understand that the advice changes for each individual and is bespoke to each individual, particularly when we're dealing with multiple assets and cross-border taxation advice. The other thing I want to caveat is I am not a tax specialist. I'm a tax specialist for Portugal, and I'm not a tax specialist in general. I'm a chartered wealth manager. So I work with tax partners. I work with tax partners in Portugal. I work with tax partners in Spain. I work with tax partners in the UK and Switzerland and everywhere else. We tend to have 4 or 5 key partners in each country, which go from kind of smaller advice, such as returns and repatriation and helping with visas, all the way up to kind of more complex stuff on the larger cases. All of the information I'm giving you on tax today is from direct cases I've done with clients on previous webinars I've done with tax partners. So please take that as information only as well at this point. However, of course, if you did want to take some advice on, we do some discovery meetings for no charge. I bring in the tax specialist to create the plan with, and then I build the strategy around your clear objectives and the tax advice. With that in mind, some of the key companies that I work with are on this screen. Some of them are not on the screen. If we're talking on the Portuguese side, I have lawyers and litigation specialists, a great partner, Veronica Bisco. I also have Abro and Marquis there, bottom left. I've done a few events with Sedalia in the past, webinars and seminars, if any of you have seen them before. And APTC up there is a tax consultants down in the Algarve. We work with bigger companies like Kutrikakos and Galvez Pereira as well, which are much more common, perhaps for private binding rulings or large kind of high net worth cases where you spend a bit more, but it's more complex. And TFO, KPMG are companies we use through UK and Switzerland as well. Okay, brief introduction to myself and the company. Now to focus on the key elements as to why you're all on the call today. So Portugal non-habitual tax residence regime, something that's been in place since 2009, something that's been extremely attractive for professionals, for business owners, for expats, for people working with foreign companies. And the reason for that, of course, is because they've had a unique structure whereby if you've not been tax resident in Portugal for the last 5 years, you can move to Portugal and you get tax exemptions and tax reductions on most of your foreign income, dividends, and investments. Now, up until March 2020, for some of you who are on the call who signed up for NHR before March 2020, you would have been entitled to 10 years of 0% foreign income tax. And you, of course, you have your exemptions on your dividends as well there. In March 2020, it changed. They brought in a 10% flat rate for foreign income coming into the country, with still the exemptions on dividends. Now, Antonio Costa, back in, I think it was September 2022 now, if I remember right. Oh no, October 2023. It's on the screen. Antonio Costa announced that he would be ending the non-habitual regime. Only just very shortly after that, a few weeks after that, I think he then resigned from government due to some fraud around lithium batteries, which I don't think has been fully proven yet. But anyway, that all happened. He announced that he announced a decree to end the non-habitual regime. That decree almost fell away with his resignation. It was then kind of brought back from the government at that point, so we weren't quite sure where we were going to stand in January earlier this year, 2024. But the government is going to uphold it. So the NHR regime is ending as it's known for, the 0% or the 10% code. That does not affect the people who are already signed up. So anyone on this call is already signed on to a non-habitual regime in Portugal. That does not affect you. Your 10 years will still run. You know, if you signed up in 2017 on a 0% code, that'll run to 2027 as normal for another, 2.5, 3 years from now. If you signed up in March 2021, then you've got a 10% code that'll run till March 2031. Okay. However, for some of you that are on the call, for perhaps the minority of you who are not currently resident in Portugal who have joined the call, you might be thinking about going to Portugal. The non-habitual regime can still be applied for, but there's certain criteria that must be met to apply for that regime. And the criteria is on these 7 bullet points below here. Now, these applications must be in and be completed by the 31st of March 2025, but you can only submit an application, and I would recommend doing it through a lawyer or through a tax specialist, which we can help with, just given the time constraints now and the criteria. But you can still do it if you satisfy one of the below. So let me just read these out very quickly. If you have an employment contract signed before the 31st of December 2023, if you have a lease agreement or other contract for use of possession of property signed before the 10th of October 2023, you have a contract to buy property in Portugal signed before the 10th of October 2023, you have children enrolled or registered in a school in Portugal before October 2023, you have a residence visa or residence permit which has been valid before December 2023, you have an application for a residence visa or residence permit that's been initiated before December 2023, or perhaps the most important one for most people, you have been a member of a household or anyone who meets the above criteria, which almost just leaves that door ajar a little bit more for many. So if you satisfy any of the above criteria and you're not already a non-habitual resident, you can still submit an application to the non-habitual regime as it currently, as it stood, which would be 10% foreign income tax and exemptions on various other elements for 10 years. I'm going to come on to the key tax benefits on the next slide. Before I round off this slide, I just want to say that the older regimes, the non-habitual 0%, non-habitual 10%, are highly advantageous for structuring corporations if you're still running a company, highly advantageous, hugely advantageous if you're retired and you're drawing down foreign capital and foreign resources and foreign pensions. And if you're not signed up, I would highly recommend trying to do so, because the non-habitual 2.0, as they're calling it at the moment, is not quite the same. Still carries benefits to it, but I think it's a little bit naughty them calling it 2.0 when it's really quite different from the previous two regimes. Not the previous two regimes, the previous NHR on 0% and 10% change in 2020. Okay. what are the benefits of the non-habitual regime? I'm going to keep this quite top level, but the reason I've got this slide in here, and this is from my previous webinar with Abro Markey and a company I work closely with, by the way, on planning. The reason I've got this here is because it's going to feed into some of the financial planning elements on the last section of the presentation. So bear with me, take as much as you can, and this will be relevant towards the end of the presentation. Now, I want to split this into two sections. On the left-hand side, you've got Portuguese sourced income, and the right-hand side, you've got foreign sourced income. And it's how things are taxed if you're on the old non-habitual regime, being 0% or 10%, so pre-2020 and post-2020, or getting on that regime before the 31st of March 2025. Of course, on the left-hand side, you've got all your standard tax, which would be paid in Portugal. Your Portuguese income tax goes from 13.5%, 13.25% up to 48%. 48% is a high band of income tax. You know, if you take your average high band of income tax across Europe, the average high band is 42%, and that's taken into consideration every country in that sector. Obviously, there's countries that are a lot lower, but some countries that are obviously up in the realms of 48, like Portugal, like your Belgians and your UK's at 45, just outside Europe now, but you're really, really in the high elements there with Portugal. Dividends and interest are taxed at 28%. Other capital incomes taxed at 28%. Rental income is taxed at 28%, or up to 14% for long-term rental contracts. Capital gains tax is 28%. And capital gains from real estate is 50% of the net capital progressive rates, but there's some exemptions around that as well. And your pensions are taxed at your progressive income tax rates, 13.25 up to 48%. That's for Portuguese sourced income. But one thing I want to say is that when your non-habitual regime ends, majority of those rates apply, not just on Portuguese source, but on foreign source. So bear that in mind, and we'll flick back to that as we talk about the financial planning sectors at the end. Okay, now, the benefits of non-habitual regime on foreign sourced income. So foreign sourced income is things from pensions, income from companies, income from employment abroad, or interest abroad as well, are of course exempt for all the lucky people that signed up before March 2020. It's 0%, zero on all of that for the 10-year period. Obviously, if you signed up after March 2020, it's 10% flat for that period. For anyone who can rush to get signed up now, if you're not signed up now before the March 2025, that would be 10% flat on all foreign pensions and income coming into the country of Portugal. Your dividends and interest are exempt during that period. However, please be aware that sometimes dividends are taxed at source, or in some cases even interest tax at source, depending on the DTAs or where your investments and shares are held in the countries. That would be looked at. Obviously, there's planning around that. If it's taxed at source quite heavily, we can look at restructuring and having a lower tax at source or no tax at source, and then being exempt in Portugal, which is highly advantageous. Your other capital income is typically exempt. Your rental income is exempt, but typically taxed at source, depending on the double taxation agreements and where your property is based. Sometimes it's not, sometimes it is, but we can cover that again. And then your capital gains tax rate. Capital gains is actually still subject to 28%. So if you get foreign investments which are not ring-fenced or in a good structure for Portugal, and again, come back to that at the end because there's planning around that, then it would still be taxed at a flat rate of 28%. Capital gains from real estate sales would be exempt in Portugal, but again, please beware of DTAs. Typically, your properties, not for all countries, but for many countries, have tax at source and where the property is based. All right, for rental income and capital gains. There are some planning tools around property. You know, Portuguese are. I have a lot. I mean, the reason I'm actually advising in Portugal in the first place is because I had a big group of my senior executives went to retire in Portugal around 2019, 2020, and then my kind of business grew from there quite exponentially over the last few years. But one thing that a lot of people typically ask me is when they're retired is, ways to start restructuring their property. I meet a lot of retirees in Portugal where the property market's obviously boomed, particularly around Cascais and down in the Algarve region, kind of the Lago, Lobo, and Villa Moura. The property markets went through the roof. They want to release equity. It's a very unique place where they don't really allow the sale of the release of equity in Portugal and to take more equity out and increase your debt levels, which for anyone who's British on the call or perhaps other nationalities is quite a common thing in other countries. So very, very difficult. However, it's important you know that if you sell a property in Portugal and you use the proceeds of that property to then buy another property in Portugal or to even invest into a kind of Portuguese compliant vehicle, then a lot of those gains can be exempt and mitigated down to negligible amounts and sometimes zero. So that's something to bear in mind as well for anyone who's in that situation. Okay, we'll come back to those tax rates when we talk about the some of the financial planning sides. NHR 2.0, or so it's been called, 2.0, non-habitual 2.0 is what we quite good record that this is kind of what's coming from Portugal next to continue attracting perhaps some expats and specialist employees into the country, but without all of the big benefits that we had before. So in order to apply for NHR 2.0, if you didn't satisfy any of the previous criteria that you mentioned, or you don't get your application in before the 31st of March 2025, then you'll be applying for this new NHR here. The big benefit is that you get a flat rate of 20% tax on income tax for even for it's looking like for income generated in Portugal from employment activities if you work in any of the below sectors. Teachers and scientists, qualified jobs which are going to provide some kind of benefits to the economy, such as activities through the scope of industry, tourism, IT and other related activities, agriculture, research and development and technology, information technology, defence, environment, energy, telecommunication. So, I mean, there's quite a broad context here, and anyone working in these sectors in Portugal would benefit from a reduced or a fixed reduced tax rate of 20% rather than your high bands going up to 48%. NHR 2.0 is still expected to have an exemption on the majority of foreign sourced dividends, some income and investments, and again, I reluctantly say capital gains and rent because most of the time capital gains and rent and properties is subject to some kind of tax locally, depending on where they're based in the DTA. However, unlike the previous NHR programs, it completely excludes foreign pensions. Now that's big because throughout my time working in Portugal so far, yes, a lot of entrepreneurs move there and incorporate there for obvious reasons. A lot of people move there and still have their overseas companies, which they withdraw dividends from for obvious reasons because they're exempt. Some people move there and are continue working in employment, teaching, and some of these key sectors we've had previously. But a vast majority of the clients that I work with, and perhaps on this call, I'd say over 75% move there for retirement or entering into retirement phase. Entering into retirement phase typically has pensions involved. Foreign pensions, whether it's self-invested personal pensions, Swiss Pillar 2 pensions, social contributions from French governments, from Belgian governments, from all of these things that come with pensions, no longer have a tax exemption with NHR 2.0. That means that every part of foreign income coming in would actually be taxed on progressive rates, which go from 13.25 all the way up to 48%. So that's a big thing to consider, and I do feel that will affect the attractiveness of Portugal as a retirement jurisdiction, which has been a big attraction for many years since that decree came in. Okay, I hope everyone's following me relatively well. I can see some questions popping into the screen, but if you don't mind, I'm going to finish the presentation and get to the end, and we'll aim to answer some of these questions back on email over the course of the next few days, or perhaps organise some introduction meetings as well. Financial planning pre-NHR and post-NHR. Now, I'm going to split and talk kind of bird's eye view about some things to consider about your personal structures and personal financial planning pre-NHR and post-NHR, but I'm going to split it into people who are wanting to stay in Portugal long term, and then people who probably are not going to stay Portuguese tax resident long term. So two very different elements and areas there to consider. Now, we've obviously just revised, we had a quick chat about the tax rates in Portugal. The big thing here, so if you're staying in Portugal long term and don't want to leave here, you spend most of your time here, you're very happy here, which I think most people do actually, then it's really important that you know that, of course, your dividends are going to go up to 28% after your non-habitual regime, and your income from foreign sources, whether it's interest or pensions, is going to go up to your just progressive band. So it's going to go from 0% up to, your 13.25, 23, 26, 43, 45, 48%, depending on how much income you take. Quite often, when I do my cash flow models with clients and tax accountants, the standard amount seems to be, I want 10,000 euros a month. Don't know why, it just always does. 120,000 euros a year. And that obviously falls into anything above 81,000 coming into the country is subject to 48% tax. I do that calculation a lot. The marginal average rate falls at around 32%, which means that on 120,000 income, whether that's rental property, social contributions, private pensions, anything that's income producing assets coming into the country after NHR, typically you would be paying around close to 40,000 euros a year on the 120,000 euros. I often get a slight gasp when I give those numbers if I'm in person at my networking events or my in-person seminars. And look, that's what to be aware of. If some of you are sitting on this call with a couple of years left on NHR, now's the time to plan. In fact, now's the only time to plan, unless you're going to leave the country. For anyone sitting here with 8, 9 years left on NHR, good. Start planning now. Start the restructuring, because it gets more difficult if you leave everything to the last minute in terms of, it's not impossible, definitely not something I do a lot, but it is more difficult over time. So it's about thinking about those tax rates and how do we restructure your assets and your holdings during NHR to mitigate these income tax rates. And I keep referring to income because income is the heavy hitter. Dividends from foreign sources, 28%. Not ideal, still high, but not the end of the world. People with proper companies tend to think about, well, how do I actually restructure my company to a different jurisdiction, or how do I actually close my company? A lot of countries have entrepreneurial relief for closing companies. You really want to restructure the wealth and assets in companies to reduce that, because your dividends are going to go from 0 to 28 after NHR. Capital gains tax is obviously flat 28%. I'll come back to ways we can reduce that, but that's on NHR and after NHR. Income is the big one. The rental income, your pension income, your social contributions, all of that is going to be hit hard after NHR if you are still in the country. And that's where I want to come on to asset classes. Asset classes, look, as a wealth manager, quite often I meet clients and they want to talk about portfolios and investments in equity picks and ETFs and passive fee. And listen, that is a very, very much a huge part of what we do and what I do. However, getting your asset classes and your structures right is priority number one. So understanding asset classes, and I'll give you a kind of a brief overview just for the next couple of minutes, is important because it's how you structure your assets, NHR and post NHR, what you hold in terms of investment strategy, equities, fixed interest, short duration bonds, ETFs, mutual funds, what that's part can pretty much fit within any asset class anyway, whether we're talking about pensions, private investments, banks, or general investment accounts, or life bonds or insurance bonds. So I want to explain asset classes and not focus too much on the investment side today because I think you're all here for the structural side. But it's important you know investments can go into pretty much any. I want to focus on two very distinct types of asset classes, and people are going to perhaps be disappointed that property's not in here, but I've covered a little bit of property before. You've got personal investments and you've got pension on the right hand side. Now, the distinct difference is that pensions are if you hold private pensions or pensions with the government or even employer pensions with existing companies, they are governed by a trustee. They're not actually owned by you as an individual. You're entitled to benefits. That can be in the form of lump sum or income, or perhaps they're more inflexible, which is only income, or perhaps they're more flexible. You can take a whole lump sum. But the big thing with pensions is that pensions don't differentiate how much the youth put in to how much the company put in, to how much the government put in, and how much growth has been made in the account. There is no differentiation in that pie chart of capital growth, income, different types of contribution. Every amount that you take out from a pension is taxed as income. And that income on NHR is 0%, after 2020 is 10%, but after NHR goes up to the high bands coming into the country. I hope everyone's following me there. So let's just take an example. Let's say you've got a Pillar One pension, which is an employer pension in Switzerland, sorry, a government pension in Switzerland, or even a government pension in France, social contributions. You might be entitled to 2,000 francs or 2,000 euros a month. That full 2,000 francs, 2,000 euros falls into your income tax bands, 24,000 a year. If you've got a private pension, let's say in the UK, like a self-invested personal pension or a defined contribution with Standard Life Reassure Aviva or something of that nature, you'll have a lump sum, which might be the value of, I don't know, say £1 million. But anything you draw down from that £1 million will be subject to income tax. Even if you've only put in 500k and you get 500k growth, doesn't matter. The full 1 million drawdown is subject to income tax. On the other hand, personal investments are completely owned by you, but they actually completely differentiate. Well, how much you put in is capital. Capital is not taxable. And then it's what type of investment structure you have. So you might have, and by the way, personal investments can be you can hold investments in a bank, in a general investment account, which is like Interactive Brokers, Keytrade, eToro, some of the big names, Swissquote. Or you can hold it in things like a life assurance investment bond, which is highly tax advantageous for Portugal and some places in Europe. But what you hold on those vehicles tends to be, well, okay, equities with dividends, or perhaps funds with capital growth only, or you've got what else can you have? You may have short duration bonds or fixed deposits, which are creating income for you as well. So these vehicles are open in nature, but you only pay tax on the growth, the interest, or the dividends, not on the capital. So some of you on the call may already be a few steps ahead now. What you should be thinking about is during your NHR tenure is withdrawing, obviously government pensions are a lot more inflexible for most countries, but any flexible private pensions, employer pensions, ex-employer pensions, Pillar 2, some government pensions can take lump sum as well. You want to extract as much of that into Portugal during your NHR period on a 0% or 10% rate. The reason for that is because if you don't, that 1 million that you draw down over that 10 years or even as a lump sum will no longer have a 0% code. It will have a up to 48%. There are some exemptions we can try and apply, but it's going to come nowhere close down to what you would get on NHR. Even on a 10% rate is good, very, very, very attractive. Then what you do is you take that capital from the pension and you invest it into a personal investment. The reason you do that is because the personal investment, all of that capital is now tax-free, and you're only paying growth, you're only paying tax on the growth that you make after the withdrawal of the 1 million euro pounds equivalent. Hope everyone's following me. The question I often get at this point is the Portuguese authorities would surely they don't like it if you take a lump sum from your pension. I've spoke to lawyers, tax accountants, and the funny thing is with Portugal is that they do not have a law written in Portuguese law that differentiates regular income from lump sum withdrawals. Doesn't exist. Most other countries, UK, France, Switzerland, and many, many more, Spain for that nature as well, annuities versus lump sum, you'd have a differentiation between income and lump sum, and lump sum withdrawals. You don't in Portugal. So what you do is you get a private binding ruling to say it's a pension, and you draw it down as an income tax rate, which is 0 or 10% on NHR. Okay. Recap. If you're planning to stay in Portugal long term, not planning to leave, very, very important, you should be looking to withdraw a majority of your income producing assets over your NHR period. Now, that's not always the case for everyone. I get it. Okay. I mean, like you may have property portfolios that are held in companies or held in trust, and that's totally different. You may have property portfolios that you're emotionally tied to, and you don't want to sell them because of the income production and you like the structures. You may have pensions that are inheritance tax free and you want to keep them where they are in the UK. But for 99% of the people I meet, it's a case of how do we get those structures restructured so you're reducing all of that income tax burden after NHR. You should be looking to utilize personal vehicles as much as you can. Now, one thing I've not introduced yet is just this third point here, bullet point 3, is what's called an ICAE bond. Now, these are vehicles which are recognised in Portugal. They're investment platforms where you can hold equity stocks, fixed different types of structures, mutual funds, but they've got a wrap around them whereby, and they're based in Europe, they're European-based investment platforms with an insurance element attached. But what happens here is that it reduces your capital gains tax down from, well, it gives you a 60% exemption. That means that rather than paying 28% tax on gains made over that period, you're only going to pay 11.2% as an effective rate. Quick summary. You've got £1 million pension or €1 million, £1 million pension. If you do nothing after NHR, all of that pension is going to be subject to progressive rates in Portugal, which would go up to 13.25 to 48%. If you restructure it and you're smart during the NHR period, you may pay 10%, you may pay 0%, depending on your NHR code. You pay that one off or don't pay it. It comes out and you reinvest. That 1 million turns into 1.3, and you have an ICAE vehicle, you're only going to pay 11.2% on the 300,000 growth, not on the capital 1 million. So everyone doing quick maths at the moment, huge differences on each side. And bear in mind that income tax would be in the 1.3 on the growth as well, not just on the 1 million pension. Right. For everyone who's on the call who is not planning to retire in Portugal, I'm going to just give you a very, very quick snippet on some countries that I've worked with before and things to consider. This will probably raise more questions than answers at this stage, but that's the point. if you're in a situation where you're on NHR, you're looking for more advice around restructuring, you're looking for more advice on what happens when you leave the country. That's why we're here. I do initial discovery meetings for no charge. So I would do an hour meeting, up to an hour meeting with you after this call. And it would just be to give you more information and focus on your situation more. I don't charge until after the discovery meetings. Okay, headline. We have covered Portugal in quite a bit of detail there, left-hand side. Just think about NHR and post-NHR and think about the structure of your assets to fit with the tax regime in Portugal. Spain. Spain is very attractive for people who are still working or have a company which they can register in Spain. The reason for that is because you've got something called Beckham's Law, which is actually based on David Beckham. Um, Beckham's Law is something that was developed from all the court cases back in the early 2000s, I think it was. What happened is you had tons of footballers and sports people living in Spain having employment income and income being generated from overseas companies into Spain. Went through many court cases, and what basically happened is they says, okay, well, what happens here is if you've not worked in Spain for the last 5 years and you move to Spain, your foreign income, your foreign sources will be exempt for a total of 5 years. So very attractive, but you must be working or employed in Spain, or you must have a company registered in Spain to benefit from that regime. And the other benefits of Spain, well, big things to consider with Spain, it's a cantonal tax structure. So it's very similar to Switzerland, which I'll come to next. Cantonal tax structures where each canton has its own tax regime. So obviously a lot of the kind of expats tend to retire in the south of Spain, around the coastline, but actually, of course, understandably, these cantons have the highest rates of tax, tend to have the highest rate of tax from income, from wealth tax, and everything else. For example, for Madrid, it tends to be exempt from wealth tax and it has lower income tax rates. So thoughts around which canton you're going to be in, Beckham's Law, but also when you're structuring drawdown in Spain, they have a very effective annuity tax rate. So you want to split your pensions, or if you can, with structuring, which we do, into lump sum and annuities. Lump sum into a pension you don't touch, it grows tax free. Then you structure annuities over kind of 3 5 years, and actually with annuities you only pay your savings income tax rate on 12% of the drawdown. So make that clear. You draw down 120,000 a year, 10,000 a month. You're not paying 21% on the full 120. You're paying 21% on 12% of the 120, which is something like €3,024 in tax each year. Big thing to consider in Spain. Switzerland is also a cantonal tax structure. Switzerland is extremely attractive for entrepreneurs because it's got one of the lowest corporation tax. It's got heavily invested in entrepreneurs, and it's good for lending as well and borrowing. Of course, Switzerland is the kind of one of the homes of private banking. So it's good for high net worths and private banking solutions for people even living in Portugal if you fit that category. Somewhere I'm obviously very emotionally tied to myself. And Switzerland's a very flexible structure. Switzerland, even with your pensions, your private pensions, even if you're 40, 45, you can actually withdraw your full pension when you leave. Well, your mandatory part in Europe if you retire in Europe, but if you leave Europe, you can withdraw the full thing and actually have very low tax rates. The key is to understand how to move your assets across cantons to reduce your tax rates. Because the tax rates for withholding tax go from 4.5% all the way up to 20%. Schweiz and Zug being the lowest, and kind of your northern cantons being the highest, 20%. The other thing about Switzerland is very, very, very attractive, and I say very, 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 is because it doesn't have a capital gains tax on shares and investments. So if you're working with a company that you've got big employer stock option schemes or stocks being built up, or you've built up a share portfolio over many years, which has grown very, very nicely through the 2015s and 16s and all the way through to 2024, then you probably get big capital gains there, and Switzerland does not tax the capital gains. UK as a structure is governed under kind of one ruling, not cantonal. Look, trust planning is quite common in the UK. Trust planning is extremely useful for inheritance tax planning. Of course, inheritance tax in the UK is one of the highest in the world. It's a 40% wipe-off when it's passed down to beneficiaries if you've not structured things correctly. and really you only have an exemption of 650k for a married couple. That can go up to 950k because you get a 300k residence allowance. But the reality is, if any of you are on this call and own a property in London, that whole exemption is gone completely. So there's a 40% inheritance tax in the UK. Big planning there. Trust planning is big in the UK. Trusts are not really liked in a lot of places in mainland Europe, however, so it really depends on where you're planning to retire. Things in the UK, obviously, you can maximise your SIP contribution, 60k a year. There's no cap on SIPs anymore, no lifetime allowance in SIPs anymore, so you can build that up as much as you like to 2 or 3 million. And they're obviously tax efficient. You get 25% tax free, then you pay your income tax on the way down. Your ISA allowance is only 20k a year, so it doesn't really provide a lot, but ISAs go tax free and are completely tax free on the way out. And then other vehicles I'd recommend for UK people going back is kind of your international life bonds. International life bonds can be taxed quite heavily if you take big chunks of capital growth back out. But if you're just looking for income planning, drawing down 5% a year, 6% a year, if you've got a 2 million bond and you're drawing down 5% a year, that's actually completely tax free. And that can run for 20 years. So, you could be drawing down 100k from 2 million, 5% a year, and that's tax free for 20 years. So that's extremely advantageous as well, if that's the structure you're looking for. Germany, very, very rigid. France is very rigid. Not much room for planning, but some key things. Germany, if you own property in Germany, and actually the property market around Berlin and Leipzig and areas like that has been booming. Very extremely low vacancy rates, buy-to-let properties. They're encouraging international investors. If you hold a property for Germany in 10 years, there's no capital gains tax, which is attractive on the sale, particularly if the property doubles over that period. France, you want to be utilising things like assurance fees, which are very similar to the IC80 bonds in Portugal. That will reduce your flat rate of tax on growth from 30% down to perhaps 7.5% plus social charges over an 8-year period, but not too much other planning techniques around France and Germany other than growing your money and drawing it down at the effective rates. Something that's not on the screen, which came up the last couple of months from my conversation with clients, is where can I move to next that would be as tax advantageous as my previous 10 years in Portugal. Look, there's always countries that open up new regimes, so things change, things adapt, and it's just important to be on top of these things with your advisor or on your own or with new advisors. The only countries right now which are really attractive is, of course, the United Arab Emirates, Dubai, Abu Dhabi, with pretty much no tax rates, and certain countries in Asia with localized tax treatment. Thailand's a big one. There's some other countries, Malaysia and some more, where they only tax local investments and income you hold locally. So if you get foreign investments and income and facilities, the foreign source stuff coming into the country is not taxed. So these are things to consider as well. Right. I'm just going to round this off now. Look, we're an independent company at Skybound, so we work with tax specialists, lawyers. We obviously work with a whole host of investment managers and investment strategies as well. These are a list of the companies we work with mainly. There's obviously over 400 companies we work with locally and across the globe, so I don't get them all on the screen, but you'll recognise most of the names. And I'm going to round off, really. So, look, I hope that everyone's taken some value from the webinar this evening. I appreciate that I can't cover everything. And hopefully I've answered more questions than perhaps raised more questions, if that makes sense. But if you are on this call and you're looking for more information, or you're looking to perhaps just get a better idea on how you would structure things with Skybound and myself, please feel free to reach out to us. As I say, we do initial discovery meetings for no charge, and I'd be happy to assist you. But listen, thank you all for joining us this evening. We appreciate it, and I hope to see you and to see your faces at some point in the future. Thanks.